do it.
Okay. Podcasting from a remote location somewhere deep in the heart of New York City. This is Crypto Characters, and I'm your host, Jason Nagi. Our guest for today is Charlie Moore, CEO and President of Global Debt Registry. Charlie, welcome to the podcast.
Good afternoon, Jason. Thanks very much for having me.
Okay, so Global Debt Registry. Why don't you tell us a little bit about what that is and what you're doing there?
Sure. So, it's a financial technology, early stage company, headquartered in Manhattan, focused on the structured credit market and improving the efficiency in which transactions are managed in the ABS space, and in particular using blockchain to enforce the asset integrity to make transactions easier, cheaper, faster, and generally address a lot of the inefficiencies that reside in that space.
So let's talk a little bit about credit markets in general. One of the things that I want to hear is your experience with credit markets, what they were like before, let's say 10 years ago, 20 years ago, maybe when you got started, and then how they've changed, where you see that going based upon the fintech innovation that you've seen, how you think blockchain may apply, and generally speaking, how you guys are applying the inefficiencies and the other problems that you're seeing and how you're fixing that.
Sure. So my background has been in financial technology across a whole host of different asset classes. So in looking at structured credit and really analysing a lot of the way the market operates and the potential opportunities to improve the efficiencies, the way the market operates really hasn't changed for 10, 20, 30 years. It's pretty much the same process. And in particular, the activities conducted are very fragmented, siloed, with no system of record, no connectivity between the different parties, resulting in a lot of risk, which is managed through a lot of service providers' cost, and activities that really could and should be digitized in 2019. So I think part of the challenge is there hasn't necessarily been either the incentives or the technology to address a lot of those opportunities. And I think the promise of the distributed ledger does start to address many of the challenges and starts to bring together those disparate players in the ecosystem so they can all sing from the same hymn sheet in terms of credit loan data, so that they can manage assets more effectively and avoid double spend type challenges, which blockchain is obviously very good at doing. So, I think it's a useful technology, but there's still the application of the technology is still the biggest challenge and opportunity. How do you actually organise an industry to embrace blockchain and take advantage of those potential efficiency gains?
So now, pull back one step. When you say credit markets, tell me what you mean by that.
Sure. So our focus has been around the ABS space, so consumer loans, student, auto, equipment, solar, those sorts of loans, and which are mainly which in aggregate makes up about 300 billion in the US alone each year. So we're not getting involved in mortgages or other areas. The mortgage space has some common infrastructure and data standards and some efficiency plays put in place sort of 10, 20 years ago, and specifically the mortgage registry MERS.
That was a mess.
That was a mess. I think in execution and operationally, absolutely, and didn't deliver some of the things that it needed to deliver, particularly in relation to 2008. But I'm sure if MERS was forming now, then blockchain would be the relevant technology in which to build a lot of it in terms of that immutability, single system of record, and keeping track of assets. So we're addressing a lot of similar sort of risks and efficiency gains, but in these smaller loan asset classes that I mentioned.
All right. So when we're talking about when we're talking about the credit markets can be bigger, but you're talking about a subset, which is really, tell me if I'm wrong about this, I would describe it loosely as a lawyer, essentially, which may not be helpful, but it's it's non-real assets. So in other words,
Right.
it's non-real estate assets. So
Correct.
it's personal property.
Correct.
And are they secured loans or unsecured loans?
So generally unsecured, but what we've started and the go-to-market has been working with the senior lenders. So the market is concentrated in 10, 12 investment banks who provide a lot of the upfront senior lending facilities and then underwriting activities to support those originators. So that's been our focus in helping them manage their collateral more efficiently, and specifically ensuring that there is a unique pledge record for any given loan, such that it's not inadvertently mispledged more than once or to the wrong place. So that's where we've started. So in that context, the collateral is the loan. It may be that it's an auto loan where there is the collateral backing up that loan, but the key is that motor credit loan from a particular originator, that loan is uniquely pledged to a given investment bank providing that senior lending facility.
Now that sounds like that's what Global Global Debt Registry is doing, right?
Right.
So now the question I have is, before Global Debt Registry came into existence, or for the loans that aren't on Global Debt Registry's platform, because you're functional now, right?
Right. Exactly. Yeah.
So before that, what is the world like?
A lot of spreadsheets, a lot of SPVs, and legal fees. A lot of
legal fees aren't bad.
They're not all bad. A lot of duplicative tasks in order to help manage the risk and trust considerations. UCC filings, but at a portfolio aggregate level. So UCC filings for these smaller loans aren't at the individual loan, not least the pool of loans that are being pledged is changing on a monthly basis. So
how does that work?
There's some outside of GDR, there's some protection at the portfolio level through the UCC filings, but historically there's been no account level system of record around that collateral activity. So GDR provides the individual loan level system of record for that collateral that can be referenced in the UCC filing to provide that additional cover. So not only can the banks ensure that the collateral isn't mispledged to somebody else using GDR, if it's mispledged outside of GDR, there's some additional protections associated with that, being able to reference it as part of their UCC filings.
Gotcha. Now, when you say UCC, you mean Uniform Commercial Code, right?
Correct, yeah.
So when I think of Uniform Commercial Code, I don't really look at it on the portfolio level. I think about it from a loan that is being secured, and as a lender, typically it'll be a client of mine. They will have a loan, and if it's non-real property, if it's personal property, then you file the UCC. And it could be on accounts receivables, it could be books and records, it could be all sorts of different things relating to some certain entity, right?
Right. So I think that's the key point, relating to a certain entity. I think in a lot of the ABS space, historically, there hasn't been an ability to specify the certain entities.
What do you mean?
We've provided a lending facility of a couple of $100 million to a particular originator who is pledging a couple of $100 million worth of loans back to us, but without actually specifying which individual loans, such as if there is a problem with a specific account number 1, 2, 3, 4, there is no recourse on the individual asset level.
So how are loans? Would you call that something like a warehouse line? Is that essentially
Correct.
what it is?
Correct.
So when I think of a warehouse line, what I think of is it's a giant amount of money that one financial institution lends to another financial institution. All right, so far?
Yes.
And there's a collateral of just a general pool of stuff. And so from what you're telling me, it sounds like on the ABS level, when you have these warehouse lines, you don't know what the stuff is. It's just everything in that warehouse, for example.
So the senior lender, the investment bank, will generally get a borrower-based report. They will get ongoing reports around what accounts are making up that pool of stuff. But as I say, historically, that's not been tied to the UCC filing. The UCC filing was still that big pool of stuff, whereas by having a system of record, independent system of record to reference, that provides additional legal enhancements. But that's provides some value in its own right. The bigger game here is actually putting additional loan characteristics on chain. This is really just the starting point, foundation, so to speak, to register the assets, register an individual account, which the investment banks are in a position to actually control that activity. But the bigger opportunity, which we see very much as a longer term phased approach, is bringing in a lot of the other additional loan characteristics, specifically the servicing and payment data, the verification activity. So the verification doesn't need to be done 2, 3, 4 times, thus saving time and money. And then ultimately the custody activity and the note moving on chain. So whilst we've seen the evolution of digital lending, that's really just the start of the borrower experience. That's not the actual asset, it isn't digital. So what the blockchain is enabling in all sorts of asset classes is tokenization, as it's called in some areas, but the digitization of an asset such that that asset lives on chain, whereas an asset-backed token, and can be transacted with that full certainty that I'm in possession of that digital loan, that digital asset. And at that point, then there's a huge efficiency gains for the market in the way that loans moved around. If you can imagine transacting a loan with the same sort of ease as transacting a cryptocurrency, then you start to get your head around that. Yes, that is a lot easier than the 6-7 weeks it takes to pull together a transaction in the ABS market.
So now, it also sounds like when I hear this stuff, it seems like it's a really sloppy market, the market itself, right? Because what you're telling me is that there's a giant amount of money that's being pledged with assets, and no one can really tell what those assets are. It could be 200 auto loans based on to people all over the country, or in a certain section, or for some car financing. There are several of them. It also strikes me that it's fairly hard to value that. So how in the credit markets, from your experience, how do people handle those kinds of issues?
I think there's been improvement in the transparency of the loan level performance post 2008 Reg AB and the advent of loan data agents. There's more loan level reporting, which provides more comfort in terms of the value and the analytics. Our focus is sort of related to that around the asset integrity. So we think of ourselves more the sort of the DTCC, ensuring that there's an efficient transaction able to occur, as opposed to the sort of the Bloomberg analytics in terms of the value pricing of a given loan or portfolio. So I think there's definitely been improvements around that loan level transparency and valuation, but that's still itself largely off chain. So there still is the potential for servicing and payment data to get out of sync, given the complex ecosystem that's involved here in terms of backup services and trustees and rating agencies and senior lenders. It is a complex, messy ecosystem where the current model, which is to say is largely offline and spreadsheet based, does have the potential for things to get out of sync for no nefarious reason other than it's humans and it's offline. It isn't, the technology doesn't control all of that loan data being in sync.
How often do you find discrepancies or issues with the underlying collateral that's just sitting there somewhere, for lack of a better word, pool?
So, it's relatively early days. We haven't found issues. It tends to be, the nature of the market is such that when there are issues, they tend to be larger scale, or they're issues that are simple mistakes that corrected at the point of time of the collateral pledging activity. So this is as much to enable a more efficient process, such that there is greater confidence in the underlying collateral, and the assets can move more smoothly through to the securitization market, and everybody having that greater level of trust of all of the data associated with the assets. But the current process is try to manage a lot of that asset integrity, but in a very expensive manual ways, be it multiple verification points, audit activity, legal work, SPVs, etc., etc. All of which we think could be more efficiently managed as the assets become more digital.
Now, when did you start getting involved in credit markets?
So it was probably about 4 years ago, and initially focused on non-performing debt and keeping track of accounts receivables bought and sold and proof of title, which certainly challenges in that space. But what I learned early on is really that the closer to origination that you're actually starting to track and manage this the loan information, the better. And then obviously in parallel over that time period, the blockchain has come to the fore as a technology of trust and supporting the immutable record keeping and distributed ledgers, enabling everybody to be confident that they're all looking at the same data. And a lot of the core capabilities of distributed ledger really support many of the underlying challenges of the structured credit market. So it's been an interesting journey of 3 or 4 years now, I'd say.
Is that when you joined Global Debt Registry?
Right.
And what drew you to that? How did you end up there?
I think having been working the previous sort of 15, 20 years doing fintech innovation, new ventures type roles in large financial institutions, I think I increasingly recognised that there was more innovation going on outside of large institutions than there was inside large institutions at that time. And there was a lot of interesting stuff going on in the fintech startup community, both West Coast and East Coast. So I think it was at that point I saw greater opportunity to sort of demonstrate my value and skill set. On doing the smaller startup thing.
So you were working for what the British call bulge bracket banks, is that right?
That is right. Yeah.
Bulge bracket banks.
Yeah.
Now, were you doing that in the UK or were you doing that here?
Bit of both. So I actually I came over here with Reuters, then Thomson Reuters, so financial information. Mm-hmm. So I started in London and came over to New York with them.
How long did you work in London for?
Probably 15 years.
That's a long time.
That's a long time. I've been around. So I went through the first .com boom and the whole startup movement, and a lot of learnings from that, and a lot of parallels in terms of some of the current trends and activities. So I like to think I've benefited from those learnings and scars, both doing some corporate startup type activity at Barclays specifically, as well as I did my own startup in the mid-late 90s, sort of post-MBA, as everybody was doing at that time. So you learn a lot from those experiences, and I've definitely seen some similar traits at this time.
Tell me,
around as well.
I'm really curious. What was the biggest lesson you learned from the .com? Because you're talking. Was it the .com bubble bust, or are we talking pre-.com bubble bust?
Well, pre-bubble bust, there was some interesting. There was a lot of euphoria in the sort of 96, 7, 8 sort of time period. There was a lot of VC money being thrown at some pretty silly business ideas, which didn't have particularly strong business plans, and had sort of excited youngsters, running around shouting from the rooftops that they've got the next best idea. And
thank God that hasn't repeated
thank
itself
God it hasn't
in
repeated
this current age. I mean, that would be terrible
itself,
if it did that.
And a lot of cart before horse in terms of what is the real customer problem and the market opportunity that you're actually trying to solve. So that there was definitely a lot of people putting that technology forward and then trying to find a solution and a paying customer on the back end. It's not really how it works.
You think that happened in prehistoric times? When the first guy who invented a knife, you think that he was selling knives to people and it wouldn't really work? If you could build your house with this knife,
right.
So we're talking now mid-90s, right?
That was mid-late 90s.
Mid-late 90s, but that was the dot-com bubble, wasn't it? That was
like
the pre-bubble
and
then it burst
around
right?
2000 mark, yeah.
So
and reality sort of set in for a lot of players, yeah.
The real question is, how much money did you lose on Pets.com, or the British version of it?
So I think the most valuable part of that whole experience was for me was the learning, and having just finished an MBA, I learned more in a year or two running my own startup than I certainly did in the MBA environment. You really do learn soups and nuts about business, everything. And I think setting up startups become a lot easier now, which is probably what's fueled a lot of the growth in fintech and some of the more far out ideas and personnel getting involved. But back in the early 90s, there was a bit more blood, sweat, and tears getting things off the ground. There wasn't all the sort of cloud services and workspaces and supporting services that are available now, or ICOs to fund them, etc.
Right.
So
back then they just called them
old school.
They just called them unregistered securities offerings.
Yeah.
Back then, right? They didn't have a fancy tagline.
Yeah.
So it actually it's interesting you say that, because from what I've seen, I work with a lot of startups, particularly in the fintech space, and it's really easy because of things, the way that email works now, the smartphones, the hookups that you can have from your iPad, from your laptop, the ease of Wi-Fi.
Right.
And you're right, these co-working spaces where you can get relatively inexpensive office space, so that if you're living in New York or any city and your roommates are annoying you and you can't have a phone call because the dog is barking, you just go somewhere else.
One of my strongest memories of setting up my startup was renting a warehouse with no heat and no wiring, or it was filthy, so I had to clean it out and lay cabling around in order to get internet connectivity, because there was no Wi-Fi in those days. So
Ether, Ether.
So exactly, crawling around on my hands and knees, putting plug sockets on walls around this warehouse facility in the cold, and the startup community these days has it lucky with all these luxury workspaces, the WeWorks, etc.
Reminds me of a story. A friend of mine says to me one day, he goes, if you want to just do nothing for a weekend, a friend of mine just got a building and he's going to tear it down, a whole bunch of stuff, and there's a lot of Cat5 wire. We can just take it all out and resell it. And all I could think of is, why the hell would we do that? Yeah. But back in the 90s, that was something that was a requirement, right? I never thought about that. You would have to lay out the Cat5, or you'd have to pay someone from the cable company money to do all of that, right?
Exactly.
Wow. Now, what were the lessons that you learned? Were they real business lessons, or were they kind of life lessons? Or that lessons that you saw people learning from the late 90s startups? I mean, was it more like have integrity, do things the right way?
Sure. I think both. You learn first and foremost about yourself, and I think it certainly gives you the confidence to go on and do other similar, greater, other entrepreneurial efforts. And I certainly, although I spent sort of subsequent 10, 12 years in the corporate world, I always respected entrepreneurs who had a go, given it a go, regardless of the outcome, because it takes guts, and B, it is a really good learning experience. You are accountable to just yourself. You've got to make it work. So you can't blame anybody else. You've got to get it done. So yeah, I take my hat off to all entrepreneurs. Although, as I say, it's got easier to do the startup or to get something off the ground, but it still does require a certain degree of guts and risk taking and sort of energy and commitment to get it going.
It does. I know that the European system for education is different from the U.S. I don't know if it's exactly the same in the UK where university is free.
Relatively speaking, in comparison to the US, it's close to free in the UK.
And I worry personally that because of the expenses that we have, that the debt that we're loading students up with, it's going to squelch entrepreneurship unless you have parents that are rich enough to pay. Because when you've got that loan payment that's due, you can't defer it forever. You can't ever get rid of it. So it's a handcuff. And I do worry that the more we do that, you can't go out and start your own business if you have a monthly payment of $1,000,
right,
without living at your parents. And maybe it's not worth it if you're coming from a suburb somewhere where they don't really have the infrastructure that you need, or what people call the human capital.
Yeah, no, I think you're absolutely right. It's my kids are at that getting close to the college age, so these are things I'm going to think about. And the model isn't sustainable, and I don't think it makes a lot of sense for a lot of kids currently. I think the actual, not just the sort of the model and the pricing, but I think the actual product is wrong. Personally, I don't think many of the 4-year programs are particularly up to date and particularly relevant. Certainly for a lot of the people that are taking them, I think you're much better off getting some sort of foundational qualification, and then the ability to have some sort of lifetime learning capability. The rate of change in the working environment, the sort of things we've been talking about in terms of blockchain and other emerging technologies, AI and so on. That's introducing a whole host of new roles and job opportunities in the workforce that weren't around 10, 20 years ago. So education is never going to keep up. So you'd be much better off with a short foundational qualification and then some ability to have regular lifetime learnings to top that up, probably online. But I don't think the current product or business model is sustainable.
No, I was listening to a college professor speak, and this college professor is not a particular fan of the current university system. And what was said was essentially, you used to go to a liberal arts college and you would study humanities to learn how to have a good life. It was about how to have liberty and a good life. And somewhere along the lines, they trace it back to like maybe the 60s, and influences of some of the bad ideas of communism started to change, and it's completely infected academia, where parents are paying. It's $250,000 now to send your kid to college. Someone told me that's probably with dorm.
Thank you for reminding me. But that is about right.
I don't plan on sending my kids to college. My wife, I don't think she believes me, but from what I've seen, it doesn't strike me as a good value. And the only way you're going to be able to survive, because I've seen the economy change in ways that it never changed. When I was growing up in the U.S., right, you would go to law school, you'd study, you'd work hard to go to law school, you get a job at a law firm, and in 8 years, if you did good and you were smart, they made you partner, and then you'd get clients, and you would try to get your own. The firm would have clients for you. You'd have a decent life. It's not like that anymore, and it's completely changed. Salaries are upside down. Associates are getting paid a lot of money. Corporations don't want the new associates working on it because they're paying a ton of money for nothing, right? So the values have shifted as to what your value should be based upon what you can do. So that's one thing. I've seen industries just disappear, which is another. And in law, industries have disappeared.
Yep.
And you look back and you look at traders, right? There used to be a ton of people on Wall Street in the 90s when I was growing up. In the early 2000s, there were guys. A lot of them, I was always surprised because Wall Street sounded like a there were all these movies about these geniuses that were making money on Wall Street. Some of these books didn't seem like they were geniuses, but they were all working for Wall Street, and they were doing jobs that don't exist anymore. I ran into one guy on a plane 2 months ago, and he said, "Oh yeah, I used to be in the trading business. We would go and we'd take like a floor broker out, and you'd take him out drinking every night, and you'd spend all sorts of money, and there was this infrastructure in there, and then you'd get the golden chair, whatever that was, and then you'd be the one making, then you'd be set for really the rest of your life. You'd still be working, but that was something that was there. The entire industry is all gone. It's all gone based upon really technological advances, right?
So how do you think technology is going to change the legal profession then over the next 10, 20 years?
You know, it's going to change it a lot. It already has. I mean, I'll give you an example, right? When I started, there were law firms, big law firms, and you would have these giant document review projects from a litigation. And there would be millions of documents, and the law firm would have highly paid associates. Maybe they were making $90,000 to $110,000, right? Their first years, second years, third years, and they would just be in a room all day, and they'd be marking documents, right? And first it was by hand, right? And then it started to be they had all these programs that you could do it online, and then the law firms, the company said, well, other companies popped up and said, we're going to do this, and we're just going to take lawyers, and they're going to be wherever they are. We're going to get them in a room. They're not from a law firm, and we'll charge you $70 an hour. And then the law firms were taking that and passing them out to the clients. The clients got wind after a couple of years, and then they were contracting directly, and then they were paying $60 an hour, whatever the rate was for the doc review project. And then all that moved over to India. And that happened within a 10-year period, all of that, from the time it went electronic to going to India or other continents to do the work. And now there's AI that's there. Watson can write a good brief, right? So it is changing the law, but our lives are always going to be changing, which brings us back to the lifelong learning part.
Sure.
If you're not willing to constantly learn, then there's no guarantee that the job you had will be there.
And the approach we're taking, going back to Global Debt Registry, is in the future for the ABS market, there still will be a need for custody and trust services and legal services and verification services and so on. But there's an opportunity for them to evolve and to embrace technology and doing those activities and do them more efficiently. So, could a lawyer be writing a smart contract to implement reps and warrants and so on, be doing things in a more automated way? Absolutely. So, we're looking to partner with and work with the more forward-thinking participants of that structured credit ecosystem, who see the opportunities to make things better and more efficient.
Now, where did you first start to see buy-in from Global Debt Registry?
I mean, it's certainly been
not names. Just like what sectors or parts were you finding interesting?
So, I mean, from a asset class within the asset class perspective, certainly the more innovations occurring around the marketplace lending, digital loan space, and I think in terms of ultimately getting the asset on chain, that's sort of where it's going to happen first. So
it's a great name for a podcast, on chain. You should do that.
So that as an asset class, but there's certainly some companies that are more forward thinking than others, but a lot of it does come down to individuals and individuals sort of who are a little bit more entrepreneurial within a large organisation, who actually wanted to take some of those risks and sort of thinking a bit further ahead. People who are thinking about retiring in a few years' time, they're thinking, how do I make my mark and how do I take market share? So in a lot of instances, it's not the sort of the number one or two market leader in those areas. It's maybe the third, fourth, fifth down the ranking. He wants to gain market share and sort of make a name for themselves. Who's sort of looking at this slightly more strategically and longer term. But it's definitely the pace of understanding has picked up and of recognition of the opportunities So for us, I think that it moved forward more in the last sort of 3-4 months of last year than it had in the previous 18 months. I think a number of factors at play. I think we're starting to see some original creditors issuing loans to the blockchain, and there's a lot of interesting stuff going on there. Not just in the US, but globally. Yeah. So that's sort of generally raising awareness. What does that really mean?
How are they doing it? What are you seeing? How are the lenders
So
putting loans on the blockchain?
there's probably more what I would call asset-backed tokens, where they're creating a token associated with the loan. So the loan is still off-chain in secure custody, and there is a token associated with it, which becomes the liquid asset. But that said, there are some players who are originating directly natively to the blockchain, such that the single immutable authoritative copy of the note lives on chain and can be transacted on chain. We're generally not advocating that we're there yet, principally because of private personal information concerns around putting PII on the blockchain. But I think that is where it's going to end up. Will it take 3 years, 5 years, 10 years to get there? Probably nearer 10 than 3. And there'll be that sort of hybrid period in between with more sort of asset-backed token type activity.
Gotcha. Now, let's talk about what Global Debt Registry's solutions are to some of the problems. We've listed a whole host of them. I mean, you've got information asymmetry as one side. You've got it's not clear who owns the loan. Where do you start in the process? It's better to start with the closer origination, the better.
Yep.
How you section out bad loans, all that stuff. So, which one of these problems did you attack?
So, day one, and what we spent most of last year was around the immutable single record of collateral for the senior lenders. So, a product we call ePledge. So, we now have over 1 million accounts registered by senior lenders across multiple facilities of unsecured consumer, student, auto, not auto, small business, and one or two other areas. So that's where we started, and our current sort of new product focus is around what we call immutable diligence, or that single verified record of the account with a hashed record up front, such that it can flow with the account as it's transacted, so that rather than a loan having to be diligenced 2, 3, 4 times from origination through warehouse to securitization, there is one single hashed record that an independent auditor, so we're working in conjunction with auditors in the marketplace, will stand behind that this has been verified with a hash attached to the collateral that we already have recorded in the registry. And then that can flow with it as it changes ownership, moving downstream.
Now, so are there companies that have said, okay, we're going to put the actual asset on the blockchain, and this hash is the asset, or are they double tracking it, which I heard some are doing?
So there's a bit of both. I mean, not in large numbers, but we're starting to see the early signs of both, principally coming out of originators in the Silicon Valley area, but globally, out of China, there's a lot of asset-backed tokens being created associated with loans. That's sort of arguably further ahead than we are over here. So, but I think the full value is when the loan is native to the blockchain. But as I say, I think putting the actual documents with personally identifiable information on chain is probably not there yet where it needs to be.
Now, there are many states that have the ability for lenders to use electronic loan documents. And I've read some of the rules on them, and they're weird because you've got to have a certain amount. There can only be one original copy, and so there's some way to mark it, and that electronic version is the original copy. It strikes me that it's easy to adapt that to adapt it to blockchain, but I would suspect that lenders might be concerned about doing that without some clear sort of authority. What are you seeing from the lender side? Is it are there folks in certain states that are willing to do it because the statutes are so strong?
I think there's definitely a need for more comfort and guidance from state and federal regulators for sure. I think, again, coming back to the sort of the 4 or 5 different use cases / value propositions that we've got here, I think the regulators generally support better record keeping and immutable records and some of that the core capabilities of the blockchain. But there's definitely as these loans become digital assets, the sort of there's definitely securities type questions and open questions at the federal and state level that the participants and the originators would benefit from guidance. Coming back to my earlier remark about if a digital loan was a true digital asset and is easy to transact as a cryptocurrency, is that then a security, which I think we've discussed previously. It starts to look and feel a lot more like a security at the individual loan level, such that it would require all of the reporting and the QSIPs and costs, etc., associated with it. So on a $2,000 unsecured consumer loan, that doesn't necessarily make a lot of sense. So I don't think that's sort of directionally where this is likely to go in the foreseeable future, although some people are advocating and talking about that. I think we'll still see the need to pool up loans into portfolios for securitization and the additional sort of risk wrappers of the rating agencies and the participants are alluded to, the auditors, etc., as we see today. But I think the way that they can be transacted and pooled and get into that securitization could and should be a lot more efficient.
So you're raising a very nuanced and interesting point, because the fact is that the note is defined as a security. It's part of the definition of a security. So if you start trading in that note, you're right, it can become a security. And no one wants to deal with that, right? I mean, then you've got to trade it on an alternative trading system of some kind. You've got to have transfer agents, potentially custodians involved. It becomes fairly heavy to deal with that asset.
It opens up a whole host of other implications, which if the asset's digital, truly digital, there should be good technical solutions for a lot of the elements, but you can't get away from a lot of the reporting headaches and regulatory cost implications that it would entail. So I think the underlying securitization model, I think we'll continue to see for some time yet.
Right, because the nice thing about the securitization is that you've got, let's call it a trust, right, that holds all of these loans. It does all the management. And then people can trade in and out of the ownership of the trust. It's typically in a bond, right? But a bond is a security. And you don't have to worry about everything because you've got this securitized pool. So it's a way to buy into the asset, but you're kind of a separate level, you're a level apart. Right. And that's the reason for the securitization industry.
Right.
That's pretty much what it is, right?
Right. But the cost of actually executing a securitization is not insignificant. It's 2, 3, 4% of the loan value. So that's a significant amount of money, which we think through the digitization of the asset and asset characteristics, that there's a lot that could be trimmed off that and make the whole process cheaper and faster as well, so that assets can flow through to the securitization market. I won't say in real time, but much closer to real time.
Right, which and that's another point. Right, there's how many times when you're having a securitization, how many different participants are there? It's like somewhere between like 4 to 7, depending, right? And each one gets a spreadsheet to look at, and it's a copy of a spreadsheet. So they're looking at not necessarily the same data, right?
Right. There is that potential. Again, there's a lot of human dependencies, and there is no common infrastructure, unlike most asset classes on Wall Street. So there is the potential for data to be out of sync. So that is one of the more complex areas of from an implementation perspective because of certainly when it comes to sort of servicing data and the multitude of different data fields and lack of data standards, which is why we haven't started there. But that's certainly part of the opportunity and the promise of blockchain is to provide improved confidence around that you're all looking at the same underlying data.
So now you said you have 1 million accounts. Is that right?
Right.
Does that mean 1 million loans, or does that mean
effectively? Yeah,
that's a nice amount.
That's a nice amount. So last year was very much around proving the concept and having banks test the technology, and there's multiple different methods and tools they can use to actually register accounts through API, SFTP. Most recently, we've introduced sort of email, the ability to capture an email and extract a file and that pre-mapped into the registry. So there's multiple ways that clients have been registering assets and getting involved. This year is really to scale and prove the value. So 1 million is a good amount to demonstrate the technology works. This year is more around proof of value, and I'd like to think that there's sort of tens of millions, many tens of millions by the year end, because it is a big market. Let's say 300 billion in value in the US. So there's tens and tens of millions of accounts that need to be registered.
So now, a couple of different things you talked about that I want to talk about. First, I would love to hear your experience with the way you roll out a product like you have to these larger financial institutions, not in a direct manner like, oh, those guys are not good, but really kind of what the phases are to even get it there. And then generally speaking, from an entrepreneurial perspective, what it is that you have to do to kind of, there's 3 different levels before you get it onto to get it, to have a platform where they say, yeah, we'll do this.
Sure.
So curious to hear about that, and also curious to hear about your blockchain, and if to the extent that you can get into not really heavy technical details, but the details about the way that it works and let's say the theory behind it and behind the way it's supposed to be implemented. So let's talk first about.
Sure. So working with large financial institutions. Having been around that space my entire career, I think key lessons are plan extensively in advance. This is not going to happen quickly. Things are going to take time. There's a lot of stakeholders to take into consideration. Both business, technical, strategic. Blockchain as a technology has obviously thrown up a lot of new teams within financial organisations looking at that. So there tends to be a pretty complex stakeholder map that you have to work with and understand their needs and concerns, and a lot of requirements capturing in a very soft manner, a lot of informal and more formal feedback sessions. So we actually ran working groups throughout 2017 into 18 where we brought a lot of the banks together to articulate some of their pain points around this industry and the inefficiencies that we've been talking about. We did a lot of prototyping activity and proof of concept activity in parallel with evaluating different blockchain technologies. To your second question,
what do you mean by proof of concept? Tell me how that works there.
So working with the client to really articulate a thesis that if we did this, it would be helpful in delivering this, and this, and then building something that demonstrates that can work technically. But as I alluded to, what we now need to do is really more proof of value, which in the case of our business proposition is around demonstrating scale and everybody participating across the broader industry. So and I think blockchain is interesting in throwing up new sort of go-to-market dynamics for early-stage companies that we didn't see in other startup cycles. So specifically, I can't remember when the book first came out, but the Lean Startup book talked about the minimum viable product, which is effectively the sort of what is the most basic product that you can deliver to the customer to start to get feedback. That was a core strategy for many startups and to a lesser extent established companies over the last decade. The Lean Startup, whose well-known author's name escapes me currently. Good book. But it really highlights the importance of getting something in market and getting feedback as quickly as possible. With blockchain startups, the challenge is in part around product, but it's in part around the network and the ecosystem. So this concept of minimum viable ecosystems actually come to the fore over the last 18 months, 2 years, where how many people do I actually need participating in this network in order for value to be created?
Minimum viable ecosystem.
Minimum viable ecosystem.
I like that. It's a
MVE. So previously it was MVP, minimum viable product. Now it's minimum viable ecosystem. So
whatever happened to words like EBITDA, the easy ones?
Yeah, right. We all love a good acronym, don't we? Make life complicated for ourselves.
That's a good point.
That is our focus now. Is that ecosystem network effect and demonstrating value by bringing multiple participants to the table. Initially with the core banks, who it is a concentrated market in terms of ABS. There's 10, 11 banks that are 80% of the volume. But then the next phase of that ecosystem development has to be sort of ensuring that the auditors and originators are obviously going to be key here. But then the other players, the rating agencies, the custodians, the regulators, who conceptually I think do actually support a lot of the underlying elements of blockchain, despite some of the crypto craziness. I think in terms of the better record keeping and addressing avoiding in part some of the 2008 issues, they've been certainly pretty supportive of what we're doing.
Wait, 2008 issues? What do you possibly mean, Charlie? Do you think that if the residential mortgage-backed securities were on a blockchain, it would have prevented the financial crisis? I go back and forth on that. The idea being that everyone would have had the same transparent information, and you wouldn't have had to, on that movie, you wouldn't have had to go to the strip club to interview the strippers and find out that they make 40 grand and own 7 houses or whatever that was. I mean,
so it's clearly no technology is a panacea, and is always dependent on how it's been implemented. And just because you've got immutable better record keeping doesn't necessarily translate into transparency for everybody. Most of the implementations of and adoption of that I see in the capital markets are very much private permission blockchains, and there's no attempt to change the transparency paradigm amongst transacting partners. They're just trying to transact more efficiently.
And actually, why don't you just explain for people that might not know what private permissioned blockchains are?
Sure. So, as opposed to openly public Ethereum, most crypto coin-based blockchain platforms,
where anybody can just kind of jump in.
Anybody can jump in, and there is full transparency and full access. The notion of private permissioned blockchains is much more in line with traditional enterprise software, but still having the benefits of blockchain in terms of the distributed record keeping and immutable record keeping and so on. So certainly in the context of structured credit, we're not changing the transparency paradigm at all in terms of who can access what data, and transacting partners want to keep that information, sensitive information, just amongst their trading partners, which is absolutely right. So coming back to 2008, blockchain technology would only help if humans were implementing it in the right way.
I mean, if they were paying attention.
If they were paying attention, and if they'd agreed that certain information needs to be attached and transparent, maybe that income was immediately recorded on chain with the asset at origination, but then that there was a human decision not to make that information available downstream. So that wouldn't help. But the fact that any immutable technology that keeps track of assets, I think clearly has the potential to address some of those issues if implemented correctly. But that requires sort of industry coordination. And certainly a lot of what we spend our time on is around industry coordination. I don't see our focus as so much a technology problem as an industry coordination problem or opportunity. As to how do we as an industry organise ourselves to do this much more efficiently. So that's what I spend most of my time doing, is sort of helping people understand how they could be taking advantage of this technology and working together and establishing the sort of the new ways of doing things and the new standards and some of the new operating models. But trying to do it in an inclusive way and B in a way that complements any sort of existing systems they've got. There's back to your question about sort of adoption across big financial organisations. It's hard to implement anything big and new. So anything that sort of can complement and run in parallel with very little disruption and sort of tech implementation required. So as I say, one of the way to register assets today is through emails, which is the easiest, path of least resistance to actually for assets to flow into our platform.
Really?
So it's literally capturing as the collateral, the borrower-based reports come through via email with some of these banks. Adding us onto the email distribution, we've mapped it such that those assets can be searched and registered close to real time. That doesn't require any technical implementation. Thus, makes it much easier and faster for the banks to implement.
Well, I know how hard it is to try to do anything with a large financial institution. So my hat's off to you for even trying and succeeding. It's quite frankly, it's amazing. It's pretty rare, I think. You don't really see that kind of adoption or getting a foothold yet. So you guys are one of the few that are really out there. They're making a difference. Now, just a couple of features of your blockchain. Just so now you have your own blockchain, right?
So we've been building on IBM Hyperledger platform.
Never heard of it.
So they've been a great partner, and we actually, having sort of evaluated 5 or 6 platforms 2.5 years ago, IBM were helpful in putting us through their digital blockchain accelerator 18 months back, and providing us with the sort of steer and some resources to get things up and running. So we got Uplight in production sort of coming up for a year ago, working with them, and we recognise that working with large financial organisations, having the comfort of a partner like IBM, who also have the strong information security standards, and we ourselves just go through our latest SOC 1, SOC 2 audit as we speak. So it's good to be out of the office. So edit that bit. It's good to have a partner who understands all of those requirements, and the banks are looking for that level of confidence, and potentially that level of implementation as things do scale, and as banks, so today banks aren't operating nodes, but as they want to operate nodes and consider writing smart contracts and stuff, across the network, then having a partner like IBM to support that, can be really helpful.
So, is there particular information that you have on the blockchain, or is it just really everything related to the loan? Are there things that are highlighted? So assuming that it's not secretive.
In terms of the collateral, there's files that are pledged to the senior lenders, it's actually relatively thin as a data set. There's no personally identifiable information. They don't want the PII. They really want to have sort of core information in terms of the size of the loan, when it was originated, where it was originated, some high-level loan and borrower characteristics. But there really is there's only 10, 12 core data fields that we require to register a loan without any of them being really what you would think of as personally identifiable information. That just makes it a lot easier to register and scale and get to that million, get to that 10 million accounts, quickly. But obviously, as we move down the product line, we will need to embrace some of those other loan characteristics and personally identifiable information, which we're ready to do from a SOC 1, SOC 2 perspective. But it just makes it a lot easier to get the momentum and get the core asset registered and use that foundation, bring in these other data sets which require originators and verification agents and other participants coming to into the ecosystem and leveraging the platform.
So it sounds to me like what you're doing is you're saying, okay, we're going to do it really small. We're going to just have a little box so you get used to it and comfortable, and then there's potential for growth as needed. Right?
Small, go deep, get as much volume as possible, demonstrate that minimum viable ecosystem, and then really take a phased approach across 3, 5, 10 years towards ultimately the loan entirely being on the blockchain. But you really need multiple loan characteristics, servicing data, the verification activity, your transactional history. There's a lot of stuff that really makes up that asset. Mm-hmm. We're just saying you don't have to do that all in one go. Let's do this in a more phased approach for multiple reasons, a few of which we've touched on.
All right. Well, I don't have any other questions for you. Is there other things you want to talk about?
I don't think so. I mean, it's been a pleasure. Appreciate the opportunity as always, and look forward to watching subsequent shows.
Thank you very much. And for those of you that are listening, a couple of things to remember about Global Debt Registry. They've got decentralized solution built on IBM's blockchain technology. It looks to enhance loan data integrity, flow through capital markets faster, at lower cost, to reduce funding and investment risk. Check it out. Look for it. Maybe your loan will be on GDR one day. Charlie, thank you for coming to the podcast.
Thanks very much, Jason.
Well, it's been 5 long years of this permanent midnight. I've been waiting for the sun to rise. I've been standing